Okay, so our guest speaker is Eric Schlanger, and he's the Managing Director of Equity Derivatives and Sales and Trading for Barclays.
Steve asked me to come down and speak today and share some perspectives with you about the way that us as professionals are approaching the market. I began my career in the early 90s in the option pits on the Amex and on the CBOE, and back then things were a little bit easier. You had tremendous bid-offer spread, you had time and place advantage. And if you're buying on the bid and selling on the offer, your strategies can tend to be extremely simple. Things have changed over the past 18 years, and a lot of the way that we look at the market, the screens that we use, and the real-time analytics are similar to those that are being employed by OptionsCity. So, Steve, I'll let you go through your deck, and then hopefully I can be additive in a few instances.
Great. Yeah, Eric, please just kind of interject any commentary as we get going through. We appreciate it. So real quickly, we just had Eric's background. And what we're going to do for the process is kind of go through a step-by-step process of what Eric spoke about. And we're going to show how we implement those strategies within OptionsCity. So the first thing that we're going to talk about of developing an options trading strategy, Eric, is our term structure. And to do that, we're going to start analyzing some historical volatilities. And what we're going to do is look at the volatility of the underlying stock, future, versus the implied of the option marketplace. We're going to take a look at the duration or calendar spreads of the individual options and how they kind of vary over time. We're also going to take a brief overview of the Skew with respect to both calendar spreads and individual options. Now, when we start putting this together, we also have a couple different objectives that we have to review as far as, do we want to minimize risk, create a strategy to generate alpha whereby we're going to be trading gamma and vega, or create a strategy to increase exposure. So Eric, how do you relate as both a past and current trader to some of these objectives?
I take it a step back and say that my clientele are constantly looking at these objectives as well. Some of our clientele use options to hedge their portfolios, and these are multi-billion-dollar hedge funds or real money accounts. Others, like insurance companies and pensions, are looking to overwrite and increase alpha, especially out in time or in an environment like we're in right now, a zero interest rate environment. Anytime you can enhance your portfolio, that's something important. And then many of our hedge fund clients are speculators, and they speculate in great size. And it's a way for them to leverage up their bets or to protect themselves by having a minimum dollar outlay, a fixed premium that they know is the most that they could lose.
Is it one of the things that I like to do is sort of a collared strategy, out of the money put versus out of the money call?
Absolutely. That goes from high net worth individuals who maybe own a great deal of underlyings to people who are trying to collar their entire portfolio and making a decision on how much they want to outlay.
Right. Are the hedge fund clientele and would be doing some sort of a ratio spread to maybe selling at the money or just an outright spec and out of the money?
I love the ratio spread more than anybody, and it depends. It's not for everyone, but I think that can be one of the most effective strategies out there.
Okay. And that also kind of ties into one of our things, the ratio spread, as we get into the risk management later part, that you have those residual gammas and vegas that you can kind of trade against depending upon your appetite.
All right, look, it's all about edge and then managing your risk. That's how anyone makes money in any type of speculation. So the great thing about options is you can quantify your risk and understand where your pitfalls might lie.
Okay. So one of the ideas that we touched upon was determining the underlying volatility versus the implied volatility of the options. And what we're looking at here specifically are the implied volatility of these options, and then the spread here, which we're looking at, of the implied volatility versus the historical volatility. So kind of key things, and what we're looking at is a tool to sort of sort, scan, and kind of create the basis of what our trading idea is.
Sure. Well, we're constantly looking at historic versus realized and understanding that it's a backward-looking metric, and yet it's a very powerful tool. So a lot of the way that I approach the market is to think of what environment am I in currently, and how does this current environment relate to what I think the future is going to look like. So in this example, if the realized is 3 under the historic, over what time period is that? Here it looks like it's 60 days. What are the next 60 days going to look like? Are they going to look similar, where there's really a 3-point edge? Or is there some major announcement that's coming out that's going to have an effect on the underlying and be different, or dampen the volatility even further?
Okay, thank you. Okay, now on an even more detailed view where we can show this is that we're looking at a 60-day moving average, and that the historical volatility is higher than the implied volatility. And we see that right here, and that would be presented as a quote-unquote buying opportunity. Again, this looks at a 60-day historical volatility, not looking forward, but we're looking past, hoping to aid in our prediction for the future.
Yeah, oftentimes, especially in the broad-based index, you can look at that like an insurance premium. So it's a profitable business to underwrite homeowners insurance over a long period of time, and there's edge in writing that insurance premium. However, if you write homeowners insurance into a hurricane in hurricane season in Florida, you're going to lose a lot of money. So how are you managing your risk to take that drawdown in any particular period?
Okay. And again, as we're looking at this, there's various sources out here. This source is from LiveVol, and we can look at 30-day, 60-day, 90-day, 120, and there will be some changes in the dynamics of these graphs.
The theory was that if you're trying to trade 30-day options, you should look at 30-day historic in different buckets of that time period. If you're looking at to trade 2-year options, you want to look at 2-year historics. Again, I try to vary that to what do I predict the future will. Predicts maybe the wrong word. What do I think the future environment will be like compared to the past environment, and then match up those environments to then see where historic is versus implied.
Yeah, I think the other idea is that, you know, there may be an earnings play, or, you know, you're going to be very active trading this for the next 6 months. Therefore, you'd look at, you know, 180-day options and the kind of Greeks that you could generate from various option strategies. So again, now what we're looking at here is a little bit different from the previous slide. And we're focused where the options implied volatility is now over the historical or the implied of the underlying. And that represents a quote-unquote selling opportunity of the options. Now we're going to go into where we look at the money. We're looking at the spiders right now and kind of what there is. So the idea that I'm trying to present here is that we're looking at the underlying implied volatility and the implied volatility of the options, and we're putting together what I call the term structure, and it's how we're going to generate our skew over time. And what this is a graph of the skew. We look at the at-the-money volatilities and then the out-of-the-money puts. So what we're looking at here, again, are those various time frames, short-dated options, 30 days, 60 days, 90 days, and seeing how the skew changes over time.
Well, to take a step back is why is there skew in the marketplace and what is it? And skew is the difference in volatility per strike. So before the 1987 crash, people tended to use straight line volatility. And the model that underlies the pricing assumptions is Black-Scholes model that has a log normal distribution. What we know from the log normal distribution will tell you that 95% of all outcomes will be within 2 standard deviations and 99 within 3 standard deviations. And what people realized in a meaningful way in 1987 is that multiple standard deviation moves occur with much greater frequencies than the model will predict. So what option players did in order to counteract, use the Black-Scholes model, and yet make allowances for multi-standard deviation moves is to build in skew. And the out-of-the-money puts frequently trade for much higher volatility than the out-of-the-money calls. An exception used to be gold, where the out-of-the-money calls would trade for a higher volatility because you had freak show moves to the upside. With that said, if you didn't have standard deviation moves, multi-standard deviation moves that were greater than the model predicted, you could make a great living by selling the out-of-the-money puts and buying the at-the-money, selling the out-of-the-money options and buying the at-the-money. And yet it's still a great tool to figure out when is the appropriate time to sell skew, when is the appropriate time to buy skew. And as a speculator, you want to know what the levels are prior to making those.
All right, excellent point, Derek. That's exactly what we're trying to show is the various strategies when you want to sell skew, buy skew, and the different options that you have.
You going puns, Steve?
I know. Okay, so what this means now, putting it all together, is we're starting to generate our skew. And as we start taking a look at it, sorry for the flickering, is that we're starting with an at-the-money volatility. And then we start looking in this model that we're working with at a 45 delta option, 25 delta, and 5. And these represent these points which can be dragged or dropped. And the blue line happens to be the volatility surface that we've started to create with the skew. As you can see here that there's a slight upward slope on the downside skew. It's a confusing statement, but it's that situation where you have more volatility in the out-of-the-money puts relative to the out-of-the-money calls. Okay. And as we start looking at this in the highlighted area in yellow, is that we're starting to develop kind of our term structure. So we can look at the January option, February, March, and so on. We also start at the bottom, start analyzing a number of different things within our data points. That we're looking at the month that we're trading at, the strikes that we're looking at, and we start generating all the theoretical values from straddle. And what we've got here is a nice way that we can compare, as we start making changes, the theoretical value from yesterday to today, or whatever changes that we make, we can see where we're adding or subtracting value.
So when I look at the term structure, we could spend a day on term structure, but it's crucial. Let's take a couple examples. If you had a biotech stock XYZ, and you knew that they had a trial that was coming due in 6 months, but options were the same volatility between now and the 6-month time period, and that trial was going to move the stock a great amount. Let's say it's going to move the stock 25% either up or down. You could make a great deal of money by selling 4-month options and buying 6-month options. Because for 4 months, it's going to realize less than the implied, and then your options are going to expire, and then you're going to have this 2-month option into a tremendous event. The opposite of that is a cash takeout. If you knew a stock XYZ was going to get taken out in the future, it would be beneficial to buy near-term options and sell longer-term options. The longer term, assuming it's a takeout for cash, the longer-term option premium is going to go to 0, and the near-term is going to explode on the takeout. We think about that in the broader-based indices as well. If they were straight line, the volatility across the board. So right now in the S&P, it's 15 vol. It's 15 vol across the board, and you know that, or you surmise that the world is not going to realize 15 over the next 30 days, but then we have an explosive event because of Iran or because of the European situation, then to sell near term and buy further term makes a lot of sense.
Right. Those are great points about what type of strategy that you want to implement based upon your outlook for the near term and longer term. So we've gone here and we've created our term structure. And now what we're going to do is overlay that to the marketplace. And remember from our previous graph where based upon our assumptions, we highlighted both a selling opportunity and a buying opportunity. What we're looking at right now is our overlaid our value to the live market, and we're looking at the E-minis, and here are the individual months that we could trade. And what we have are the calls on the left and then puts on the right. And we're comparing theoretical values of the bids in the marketplace to our theoretical value. And then the same thing on the calls. Our theoretical values down the middle. Here are the bids, here are the offers. And we have what's called a heat meter to show you how much edge you want. This is really kind of a point for a later date. But again, it's just how we're displaying how your values are to the marketplace. Okay. And we can point and click trade, or what we're really pushing for, what our customers are demanding, is that they want to be able to, once they have created a strategy in one stock, that they're going to filter out to scale it up into a number of different stocks, whether it be a basket of biotechs or bank stocks or a bunch of commodities. But they want the same tools to be able to execute in an equity as opposed to a future or the various commodities. And so this is what our application looks like. Now, we alluded to being able to create an electronic eye strategy to scan the marketplace and look for your buying and selling opportunities. Eric spoke about in his first part that being market makers back in the day, that we had tremendous bid-ask edge and the opportunity to make money just on trading that. In the old days, if you stood closer to the bid, you were quote-unquote faster and had the opportunity on trade. What we now have is an electronic interface that's going to scan all the marketplaces to find your buying or selling opportunities based upon your strategy.
Right, with the bid-ask spread as narrow as it is and the cost lower, your edge isn't in the bid-ask. Your edge is in understanding the distribution that's implied and applying your own models to the current marketplace and then being able to trade on those theoreticals.
Correct. There's been a dynamic shift in the change of the marketplace. The volumes have exploded. The bid-ask average has shrunk. So it's just creating your strategy to generate the Greeks and take advantage of your perceived opportunities. What we then do, after we've found our opportunities and executed them, we're going to start managing the risk. So what I've got here is my position broken down by the individual months, February, March, the individual strikes. And I start putting together my quote-unquote options portfolio broken down by strike the position. So if I look at the 1260 calls, I'm short 400 and I'm long 500 of the puts. And it gives you an idea. Then we start breaking down the total of options that you're long or short. The total delta is broken down by month, and the gamma, vega, and theta. All these trades that we do ultimately have got residual Greeks that we can use to analyze and hopefully minimize our risk. And I'm going to go from our position. Do you have any comments right there?
I was just wondering if you had risk slides on.
Yeah, I do. The next picture is our risk slide. And what we're doing is the at the money is highlighted in the orange, and then we're looking at down 1%, down 2%, down 5%. Again, this is all customizable into your span, and we start getting a look at our Greeks right there.
Right, and that's a similar way to how we're analyzing our books on a bigger scale.
Right, excellent point that because as the Greeks change over time, so does your risk view. So you could be quote unquote delta neutral one day, 3 weeks pass, and then you've got a completely different risk slide because some of your options came off.
Right, you're subject to changes in spot, changes in vol regimes, as well as changes in time.
So then there's our traditional risk slide right there.
I would think managing your risk is as important as your strategies. So a lot of what we think about is if you're selling options, you're going to make money every day on your theta, and then one day you're going to lose. And you're hoping that you make $1 every day, and on day 10 you lose 8, you keep 2, and you do that over and over again. And if you're buying options, you're going to end up paying theta, and for 8 days you're going to lose money because you've been paying out the theta, and then hopefully on day number 9 or 10 you're going to make more than all the theta that you paid out. And you have to be able to be in the game long enough to do that, and with the right type of discipline and the right type of strategies, we're able to make money over time.
Excellent. Okay, so now what we're going to do here is kind of just move into, and this will take 5 minutes, and what we're going to do is show kind of how this all ties together in real time. Okay, bear with me 1 second. Okay, so the first thing that I'm going to do is I'm going to go calibrate my volatility skew. So I'm looking at equity right now, and first of all, this is the skew that I have in the marketplace. Okay, what I'm going to do is bring the live market into the blue are the bids, the reds are the offer, and so I get a comparison, and I can see where my volatilities are off. And looking at this, just by zooming in, is that I can see that my volatilities are too low. My at-the-money volatility is lower than where the market is. And the differences are shown in this pink. Now what I do is I apply the implied, publish to the marketplace, and then go to my RIM, my March options, and here's our theoretical value in the middle, and this is the theoretical value for the puts. Now these out of the money calls are showing as our only opportunities now, and if I wanted to buy this March 35 call on RIM, a giant spec, I would just point and click, bring it up, say I want to buy my 50 contracts, execute, and I'm done. Now you can tab in between individual months, and here's a scenario where my skew is incorrect. And what I'd just like to do is just give you a feel for how we're presenting mispricing or not, okay? That right now it's saying that these options are overvalued and these are undervalued. Because everything is out of whack, it tells me that I'm wrong. So what I would do is I'd quickly go in and change it. So we were looking at the April option. If I wanted to, now we go back to those April options, and only a few of them are out of line. Remember how everything was lit up in orange there, Eric? So how could we take advantage of this? We're going to create an electronic strategy where I highlight the range that I'd like to look at, create our electronic eye strategy, and in those scenarios where we're analyzing, we can both buy and or sell the specific options in the calls, and or the puts just by kind of clicking on them. So there's a lot of ways that you can kind of tailor. If you just wanted to be a net option buyer, we wouldn't look for selling opportunities. You can just tailor it to buying options and a specific strike or a range of strikes.
Yeah, I think that goes to a further discussion of overlaying smart option strategies and pricing evaluation with a thesis on the overall market. So if you're looking at the world today, volatilities have come in tremendous amount over the past 2 months. Really, after Thanksgiving, vols have done nothing but come in. Skews come in quite a bit. And if you were thinking, I want to own a lot of options to protect a portfolio, then you might as well be picking the best one. So if you can use screening software to screen which options you think are the best, which term structure, which strike, now you have the wind at your back when you're making an evaluation. If I think Caterpillar is a good buy and I want to buy calls on Caterpillar, but the volatility is high and the upside skews flat, then maybe instead of buying calls, I might be better off buying a call spread, or I might be better off buying a 1x2 call spread. I think that these tools that you have are another piece of your arsenal in evaluating the market to make the best decisions in the most appropriate way at the best price.
Right, thank you. So what we've done now is we highlighted the range that we're interested in trading, and then it presents us with our quote-unquote opportunities. And then, as you can see, they kind of come in and out. If you want to trade, you would just click on the order side that you wanted to do. Hit sell 50 of these, and then you're done. Okay. Now we also have the features to be able to auto-execute, or right now these are highlighting as just selling opportunities. We could be scanning for just buying opportunities. So now we've kind of put on our strategy where we sold some options, and we're going to go in and take a look at the risk. We'll go under RIM. First of all, we'll take a look at our position and see how that lines up. And then we'll go into the risk span. And then we're going to see at time how our Greeks change over time. And we could look at other stocks in our position and just kind of see what our P&L swings are going to be on the individual moves. From that, then, we could also go back and recalibrate not only our skew, but the option strategies that we'd like to buy or sell. And again, so we've gone from creating our skew, overlaying that to the marketplace, and seeing what sort of opportunities presented itself. Developing an outlet or a strategy to minimize risk, expand risk, and sort of kind of got engaged in trading, and then thereby, again, recalibrating everything that we want to do.
It makes a lot of sense to me. That's the basic blocking and tackling of how we approach the marketplace.
I'm going to just open it up now and just see if we have any questions. There's a couple questions out there. 1 second. Okay, so now that there's a, and I'll turn this over to you, Eric, on this, about executing. OptionsCity connects to a number of different firms, such as Barclays. Of course, we'd love to connect to them and increase our footprint there, but via their fixed protocol that you can connect into their order routing system.
Yeah, well, look, at Barclays, we're trying to do a number of things. On the institutional side, we're trying to be advisors to our clients. and utilize a lot of the tools like you have at OptionsCity and overlay that with our research and our thesis of the world and plug into the traders who are trading in each individual sector and provide the best outcome for our clientele. We also have a whole suite of electronic option opportunities, and part of that is our extremely quick fixed connection and competitive rates.
Right. Okay. At this point, I think people are just, judging from the questions in our webinar here, is that they'd really just like to have somebody from Barclays or OptionsCity contact them regarding getting some material, and whether it's Barclays research or connectivity options. So in order to do that, we'd like you to contact JT Tanakis from Barclays, a great person who I've known for a number of years, and we look forward to doing a lot of business with you guys in the near future. Yeah, JP's number is area code 212-528-7480, and we'll contact you all. We'll send a follow-up email with everybody's contact information. Eric, I'd like to thank you for taking the time to join us today, and your outlook was very informative.
Thanks, Steve. Thanks for the time. I appreciate it.
Thank you, everybody.